Ravikant Bhatt, AVP Research with IDBI Capital Markets joins in. Ravikant, great to have you with us. I want to talk about first the headline number, 702 crores versus 551 crores for Yes Bank. But the asset quality has deteriorated sequentially with gross NPAs at 0.76%. What's your first reading?
The profit number seems to be good. As far as the gross NPAs are concerned, they have been inching up steadily over the last quite a few quarters, and that seems to also be in line with the credit growth that the bank is showing. But I think that's some cause of worry, because I would have ideally expected the inching up to halt somewhere, given that they're actually coming down from a very small number. I mean, in first quarter of 14, the gross NPAs used to be just about 22 basis points, and they are up more than 3 times now over these many quarters. So I think we need to hear out the management more on what's the outlook over there really. But looks like this, they have managed it quite well. The profit is much better than what we had expected.
Ravikant Bhatt, AVP at IDBI Capital also joins in. And Mr. Bhatt, great to have you with us. First up, in fact, Mayuresh Joshi also joins in. We'd like to get in your thoughts on the net interest income that has come in at about 1241 versus the ET Now poll of about 1210. And on a year-on-year basis, again, this has gone up 977 crore rupees. So there has been a smart uptick there as far as NII is concerned, the bread and butter business of a bank. Mayuresh, first up, your thoughts. How are you reading into these numbers?
Morning, Kamya. The NII growth a tad bit better than what we expected, and largely this would be on account of belief in a strong growth in advances as well as the retail and CASA deposits. But one really needs to look at those numbers coming through. The profitability has been better than what we expected. We expected around 675 odd crores to come through. What happens to the asset quality is something to be looked at. Though they have given a strong performance over the past few quarters, and though we saw a marginal rise in both GNPAs and net NPAs in the past quarter by 5 and 2 bips, I think sequentially there should be some amount of rise on that front. But again, I think what happens largely with the asset quality outlook from the management and the credit cost outlook, where they have guided for a 56 bips annualized credit costs, I think that would be very, very key. So I think the credit cost guidance had been reduced to 50 bips, so that it maintain that going forward. What happens with the PCR? I think all these aspects need to be noted at this point of time for Yes Bank.
Hi Mayuresh, this is Poonam here joining in from the Mumbai studio. Mayuresh, what do you make of the margin trajectory itself? We are seeing stable margins coming in there. We are seeing a huge steep rise in terms of the gross NPAs itself during this entire quarter. The gross NPAs in fact have jumped to 748 crore versus a 558 crore in the last quarter. So there is a good amount of jump, but if you look at the gross NPA ratio itself, it stands at 0.76% versus a 0.66%. So still below the 1% mark in terms of the gross NPAs. Stable margins coming in there in terms of Axis Bank. Mayuresh, what is your call on both these parameters for Axis Bank?
So the NIMs, largely our expectation was that it should be around the 3.4% mark. With the bank reducing the rate offered on savings deposit from 7 to 6%, that has largely helped in reducing the cost of funds for the bank, and that is probably one of the determining factors why the margin stability is being witnessed. What happens to the non-interest component book is equally important when you're looking at how the larger picture pans out. When it comes to the absolute asset quality picture, yes, I think you might have sequentially seen a rise, but one really needs to understand where the stress has come from. Even on the net asset ratio, I think one really needs to see what kind of provisioning that the bank has done and what kind of accretion has happened on the CASA front, specifically in terms of, as I mentioned earlier, on the retail and the CASA deposits. I think this is going to be a very important trend for the bank going ahead.
Right. I have some more details from the press release to be shared with our viewers as well. The press release mentions that the credit costs have been contained at 50 bips for FY16 and the entire impact of RBI AQR has been factored in. It also mentions about the gross NPAs. It states that provision cover stands at 62% for this entire fiscal. Standard restructured assets are at 0.53%. That is at 524 crore during this quarter versus 568 crore during the last quarter. quarter. So more or less some marginal decline coming in terms of the standard restructured assets. Security receipts stand at 199 crore, which is 0.2% of the gross advances, versus 212 crore, which is 0.25% of the advances in the last quarter. So very marginal dip also coming in terms of the security receipts. There is nil SDR, there is nil 525 refinancing during the entire FY16. This is the entire asset quality picture that the management has declared in its press release. Ravikant, what do you now make of this entire asset quality picture?
No, like I said earlier, the asset quality has been inching up. I would see the management had very strongly had been reiterating that for the full year the credit costs would be contained at 60 basis points, and the same was revised slightly lower post third quarter. It's been contained at 50 basis points. So I think one also needs to track what the management has been saying, apart from what the gross NPA numbers are eventually coming out, because they seem to be still managing it quite well. Secondly, we also need to track the margins. That's where the structural changes are going to happen, because the CASA has been expanding, and with that happening, the bank is definitely going to have a much more stronger operating profit that should be also able to cover up some of the rising credit costs that we are likely to see. All in all, what I would look out for is how the credit cost guidance pans out for FY17, because until last quarter the management hadn't talked beyond fourth quarter, and therefore it would be interesting to hear out on the outlook ahead.
Right, Mayuresh, this question comes to you since Ravikant was also speaking about the CASA ratio. I do have more details in terms of the CASA deposits here. The CASA ratio now has improved to 28.1%. So every quarter, in fact, the bank has been able to improve on the CASA ratio. In terms of CASA growth, the entire CASA growth has been at nearly 48.7% on a YOY basis. The savings account deposit growth also has been robust at 62% on a YOY basis. And the total CASA plus retail fixed deposits now stand at nearly around 55% of the total book. So the entire granularity in terms of the retail franchisee on the liability franchisee is definitely improving. What is your take on this, Mayuresh? And I also have a second part question in terms of the valuations and the stock price. Do you think that the stock, which is already at a 52-week high, do you think there is more legs to this entire rally for the stock price? So two questions coming in for you, Mayuresh.
No, Poonam, again, the granularity is being seen very evidently. Even if you look at the quarter gone by, they had seen robust traction on the savings deposits front, which grew 64%. As you're mentioning right now, it has gone 62% on a YOY basis again for this quarter. So the bank's retail franchise is growing at a very, very healthy pace. The CASA ratio, which has come way above 28%, is a testimony to the fact that the bank is doing right moves in terms of shoring up its retail book. And that is very evident from the numbers that we've seen right now. So clearly, I think Axis, Yes Bank, in terms of how their book is panned out, what has happened with the restructured assets, there has been no sales to ARCs, there have been no 525s, no SDRs. I think that is going to be very, very positive. As you're pointing out, credit costs, as my colleague analyst was pointing out, is going to be a pertinent trend going forward. And as far as valuations are concerned, I think they are reasonably valued at this point of time, about that 2.2 times price to adjusted book on an FY17 basis. So one really needs to understand how the management outlook is going to be, A, on how credit costs are expected to pan out, B, I think what kind of trajectory the management is talking about in terms of both their advance and their deposit book growing, which will have further accretion in terms of how the NIMs and the NIIs for the bank will spread out. And 3, largely, how is it going to be in terms of their branch network expanding? So that is going to be a pertinent point as well in having the operating leverage benefits play out in terms of how the future earnings growth and trajectory for the bank will pan out.
Okay, I think we can just sum up the quarter as a little bit mixed for Yes Bank right now. You've got the asset quality, which is a tad worrying this time around. Net interest margins have come in fairly stable, and the key takeaway is also that the board has approved raising up to $1 billion, and this is via equity capital issuance. Some more details by way of numbers: a major up move in the other income at 803 crores versus 590 crore rupees. The provision coverage ratio stands at 62% as on March 31st. The capital adequacy ratio, as Poonam flagged off, is at 16.5%. They will be paying a final dividend of 10 rupees per share. And looking at the press release as well, the credit costs have been contained at 50 basis points for FY16. And they are saying that the RBI AQR impact has fully been factored in. Commenting on the numbers as well, you have the management saying that they've delivered another quarter of highly favorable performance across all key parameters of growth, profitability and asset quality. But I understand, Poonam, you have some more details on the numbers?
Yes, Savan. In fact, we do also have the advances growth here. The advances at at 98,209 crores, coming in a very robust growth of 30%. I would say very few analysts on the street were expecting an advances growth of as high as 30%. Of course, majority were expecting advances growth of over 25%. But 30% advances growth in this kind of a market is definitely pretty strong. Although, of course, your entire base, the balance sheet size is slightly lower. So, if I could just ask one more question to any of the analysts, and I would just pick up Ravikant here. Ravikant, we are getting two updates now. One is, of course, in terms of the board approval of $1 billion in terms of the capital raising and the advances growth of 30%. But I do remember that the $1 billion capital raising was also available in terms of last fiscal as well. And since this is a new fiscal, we still have the board approval continuing there. So it's a two-part question again. In terms of the advances growth, do you think that a 30% odd advances growth, which is far higher than the industry, is this a trend sustainable? And how soon would actually management have to go ahead and raise this capital in FY17 itself?
The board approval was taken last year. It was valid for an year. So I believe they should have raised the capital by the first quarter of FY17. I believe whatever approval it has come through, it's in continuance of what was taken already earlier. And probably if that's correct, if it's not a fresh approval, then maybe the bank would going to raise, close the transaction in the first quarter itself. That apart, $1 billion is of equity is quite a sum, and obviously with so much of equity coming in, you then start talking about leveraging it and how soon you can leverage to bring up our return on equity in a more, improve the return on equity over the next 2 to 3 years. No doubt the ROE is going to get suppressed in the immediate year, but obviously everyone would be looking forward to how it eventually improves. And I think from that perspective, the bank would be looking to actually deliver a very, very strong credit growth rate. And the focus here would, I would believe the focus would increasingly shift to retail, because that's one aspect which the bank has been very increasingly talking about, discussing in quite a more detail about growing that particular book. So I think we are going to hear quite a lot on that particular front, and therefore probably one should not be surprised if now the management actually talks about maintaining plus 25% kind of a growth rate. Of course, how it comes through and what's the game plan over there is something that one needs to look out. But one should not be surprised if the credit growth that is targeted is much stronger.
Yes, indeed. That would be important to monitor. Those are the trends as well when it comes to the asset quality. And as you can see, it has inched up sequentially from 0.2% in the second quarter of FY16 now to about 0.29%. And that would perhaps be the only disconcerting factor in the numbers this time around, because on pretty much all the other parameters, it's been a fairly encouraging set of numbers. And there you go. Asset quality once again has been a little bit disappointing. But as Poonam flagged off, advances high by 30%. And that could certainly be taken down well by the street. The total deposits, by the way, at 1.1 lakh crores are up 22.5% as well. The total assets of the bank have grown 21.4%, and you also have an ROA in the fourth quarter, of 1.8% and an ROE of 21.1%. Mayuresh, just by way of the kind of the ROA and the ROE that even Ravikant was flagging off, do you think that credit growth is likely to be maintained, that we might see a little bit of a crunch down when it comes to the ROA of Yes Bank?
Looking at the advances growth that the bank has pretty much delivered over the past few quarters and what kind of numbers they posted this quarter around, the advances growth should be pretty strong. And the entire focal point of the management, as Ravikant was pointing out, would be towards the retail book. And if those advances stand extremely strong and the management commentary stands strong as well on that aspect, my own take is that the advances growth in excess of 25% can be easily achievable. And you're probably seeing, Avan, at this point of time that the credit growth cycle has not picked up meaningfully for the entire sector as a whole. If one really expects the second half of this fiscal, the credit growth cycle to pick up meaningfully on a low base, that would imply that banks like Yes Bank have sufficient headroom to probably increase that rate at a much faster pace than a lot of the PSU counterparts. So I think that advantage inherently stays with the bank as well. So yes, I think the advances growth, in my opinion, should be pretty strong over the next few quarters. And that will have some amount of positive trajectory in terms of how the leverage plays out. What happens with the dilution might have some amount of compression from a medium-term perspective on the return ratios. But the long-term prospects with increasing retail book, with retail growth, the retail deposit base, I think will act positively for the bank with both cost of funding going down. And again, I think the NIMs being maintained at these levels would be a key positive for the bank going forward as well.
Okay, let you go on that note. Mayuresh as well as Ravikant, appreciate you analyzing the numbers for us. And Poonam, thanks very much for all that number crunching. The stock price of Yes Bank, after hitting a bit of a low on account of that asset quality, has managed to recover 907. It's been a fairly stable quarter. We take a quick break right here on the show and get you a lot more perspective on the other side. Stay with us on Hot Stocks.